Imagine you're driving a sports car on a long road trip. It's fast, it's sleek, it's thrilling, but you wouldn't use the same car for off-roading in the mountains. That's what a lot of investors are doing right now, though. They've been riding the tech stock boom, but they're ignoring the terrain ahead. Today, I'm going to show you why rotating some of that money into the Dividend Aristocrats, the SUVs of the stock market, could protect your portfolio from the bumps ahead. Here's the problem. If your portfolio is overloaded with large cap growth stocks, that's your sports car money. You're carrying more risk than you probably realize. And with market volatility picking up, that's a dangerous place to be. Even this year alone, as I record this video, the NASDAQ, the tech-heavy index, is down over 11%. The broader S&P, down about 5%. The Dividend Aristocrats, they're up 2.5%. That's not a fluke. When you look back at previous down years, the trend holds true. Let's go back to 2022. That was our last big drop in the stock market. The NASDAQ dropped 33%. The S&P 500 was down around 18% that year. Dividend Aristocrats only down 6.21. And so exactly what is a Dividend Aristocrat? It's a company that's in the S&P 500. And it's not just a dividend payer. It pays a dividend, but they've raised their dividend for at least the last 25 years. These companies are built differently. They're well managed, they're financially solvent, and as a result of that financial strength, they tend to hold up better when the markets get choppy. We'll talk in just a minute about how you can actually implement a strategy like this. But first, let's dive into exactly what types of companies make up the index. Check out this graphic. The index currently has 69 companies across various sectors. Here's a couple of things that'll stick out to you. Consumer staples dominate. Think about like toilet paper and toothpaste here. There's also a strong mix of healthcare, industrials, even some financials. But tech stocks, they only make up about 3% of the index. So if you're looking for stability in the stock market, this is a pretty good place to find it. Think about your stock portfolio for a moment like a house. Growth stocks, they're like a beautiful glass mansion sitting on a cliff. They're stunning when the weather's calm, but they're pretty fragile in a storm. The Dividend Aristocrats, they're like a big brick house. They're steady, they're reliable, maybe they're not as flashy, but the wind starts howling and they hold up just fine. The companies in this index are leaders in their industries. They've survived recessions, inflation, market crashes, and they've done so while continuing to raise their dividends year after year. Now, why is that important? It's important because dividends provide downside protection during bear markets. When stocks drop, dividend income gives you a cushion. Think of dividends kind of like rent payments. These companies are paying you just to own their stock. So even if the stock price stayed flat, you're still making some money. And if stocks are dropping, those dividends can help cushion the falling prices. Another plus versus just any old dividend paying stock is that a company that's consistently raised dividends for the past 25 plus years is less likely to need to cut them when the market dips. And so that all sounds well and good, but how do you actually implement this without derailing your portfolio? First off, this does not mean sell all of your growth stock. That's not a smart plan either. But if you haven't been actively rebalancing your portfolio over the last couple of years, the growth money's likely grown and taken over and thrown you way out of whack. And so here's a couple of ways to get things back in line. Step number 1, assess your asset allocation. Check to see how much of your portfolio is in stocks to start, but more importantly, what kind. Most investment platforms have tools that'll help you analyze your holdings. Pretty easy thing to do. Or ask your financial advisor if you're unsure. If your growth stock allocation, your sports car money, is way ahead of your value holdings, it's time to rebalance. Aim to bring that to at least a 50-50 split, or you can lean a little bit more toward value if you want some extra protection. Second up, how do you actually invest in the aristocrats? Now, at this point, there are exchange-traded funds, ETFs, that follow the index, or you can buy select individual stocks or buy all of them if you prefer a little bit more of a hands-on approach. There's not a single right way or wrong way to hold these sorts of stocks. The important thing is making sure that you're shifting and balancing out your stock portfolio, as it looks like we've got some storm clouds on the horizon. Third, finally, this should be done as part of your overall 3-bucket plan. If you've been here before, you know that I'm a bucket plan guy. Give different money, different jobs in retirement to have a more well-rounded and resilient retirement portfolio. This move fits in perfectly with that. Your growth bucket, your bucket 3 money, has had a really good run. Now, you can either turn the volume down on that bucket by shifting some of the stock holdings, or you can move some of the gains that you've had over the last few years down the line to bucket number 2, to your income bucket, and hold these sorts of stocks there. Still not sure if this is a good idea? let's go back and revisit the numbers one more time because the data doesn't lie. In 2022, our last down market, the NASDAQ was down 32.97%. The S&P was down 18.11%, and the Dividend Aristocrats fell just 6.2% that year. This year, tech is down 11, S&P is down 5. Dividend Aristocrats are actually up. If we go back even further, 2008, the dot-com crash, the moral of the story is that high-quality stocks, ownership in fundamentally strong companies that pay a dividend is a solid strategy in times of market turmoil. This pattern's repeated itself over multiple market downturns. If you're serious about protecting your retirement income and creating a resilient portfolio, I got two powerful resources for you. They're down below. Download my no-cost guide to building your retirement income plan and the Social Security guide that's down there. Links are down in the description. Both of these guides will walk you step by step through creating a solid income plan and maximizing your Social Security benefits. While you're down there, don't forget that subscribe button. It's down there somewhere too. Go ahead and subscribe to the channel. Come back and see us again. Remember that managing your portfolio is not about chasing returns. It's about creating a solid plan that works for you, and a strong income plan is a key to doing just that. If you want to learn more about how to structure your retirement buckets and build an income plan for your own retirement, I got you covered. Check out this video right over here where I break it all down.